Okay, let me ask you something. Would you buy a 300,000 euro magic machine that spits out 1,000 euros a month without you having to lift a single finger? I mean, it sounds absolutely incredible, right? Well, this machine perfectly represents the ultimate financial dream that so many of us cultivate deep down, the dream of true passive income. But imagine one day you pop open the panel on the back of this machine, and you discover the cold, hard truth. The machine isn't actually printing anything at all. It's just siphoning cash out of a hidden reservoir, and that reservoir was filled with your very own 300,000 euros. This perfectly illustrates the core illusion of passive income that investors fall for every single day. Welcome to this explainer, where we're going to absolutely dismantle the myth of magical dividends and uncover the true, often completely hidden costs of income-yielding financial products. Today, we're cutting through the marketing fluff to look at the hard, undeniable math behind why getting paid from your own pocket might not be the massive win you think it is.
Here is our roadmap for today. We'll start with the magic machine, cover the math of dividends, explore the high dividend illusion, break down the income ETF trap, look at investment certificates, and finish up with the DIY dividend. Let's get right into it.
Starting with Section 1, the magic machine, and the psychological foundation behind all of this. To really understand why our brains get such a thrill from periodic cash deposits, we have to look at a famous 1984 academic paper by Schefrin and Statman on a concept called mental accounting. Basically, human beings naturally tend to create two completely separate mental drawers in our heads. In one drawer, we put our capital, which we treat as sacred and utterly untouchable. In the other, we put our income, which we feel we can just spend freely without an ounce of guilt. Now, this old Victorian-era mindset was originally great for helping investors protect their principal back when wealth meant, physical land or massive estates. But today, in the era of digital trading, the financial industry literally builds entire catalogs of highly profitable products just to exploit this exact congenital bias. Which brings us to Section 2, the math of dividends and the actual financial reality. Because while the psychology is super fascinating, the math is where reality hits you like a ton of bricks. This actually dates all the way back to 1961 when two University of Chicago economists, Merton and Franco Modigliani, published this groundbreaking proof. They showed that a company's dividend policy is completely irrelevant to its overall value. Think about it. When a company generates free cash flow, it basically has four options. It can reinvest in future growth, pay down debt, buy back its own shares, or distribute that cash as dividends. If they choose option 4, that dividend isn't some extra cherry on top of your investment. It's just a slice of the exact same pie. The stock's overall value literally drops by the exact amount of the dividend the very second it's paid out. So yeah, the money hits your account and you feel rich, but the value of the company you own has just shrunk by that exact same amount. Let's ground this in a real example. Check out Sandra's 300,000 euro portfolio to see the brutal tax reality of how this works. So, 180,000 euros is her initial capital, and 120,000 is pure profit. She wants to pull out 12,000 euros a year in income. If she takes path A and just relies on a 4% dividend yield, the taxman is going to treat that entire 12,000 euros as taxable capital income at 26%. That's a hefty 3,120 euros gone to taxes. But look at path B. If she just sells 12,000 euros worth of an accumulation ETF, she only pays taxes on the profit portion of those specific sold shares, which comes out to just 4,800 euros of taxable profit. Her tax bill plummets to 1,248 euros. So the absolutely crucial takeaway here is this bottom line, 1,872 euros. Just by manually selling a tiny fraction of her shares, instead of passively relying on forced dividend payouts, Sandra saves a staggering 1,872 euros every single year. And remember, she's holding the exact same portfolio value and taking the exact same market risk. Mathematically, getting a dividend and selling your own assets are identical before taxes. But after taxes, that dividend pathway is just a massive, completely unnecessary drain on your wealth. Moving right along to Section 3, the high dividend illusion. We are now climbing the trap staircase. So we've covered Step 1, the basic dividend. But at Step 2, we hit high dividend ETFs. These are funds that filter the entire global market to only include companies that pay out lots of cash. But here's the catch. By doing that, they basically toss out all the high-growth tech companies.
Instead, you end up with this massive, heavy sector bias toward mature, slow-growing utilities, banks, and insurance companies. You're not necessarily buying higher-quality companies at all. You're just making a highly concentrated sectoral bet that is masquerading as a safe play.
And the math behind this specific illusion is so simple it's scary. Dividend yield is just a fraction, right? The dividend payout divided by the stock price. So if a company is fundamentally failing and its stock price crashes by 40%, its dividend yield suddenly looks artificially sky high. Your trading app might flag it as yielding 9%, and your brain instantly screams, bargain. But the denominator is just collapsing right before the company inevitably cuts the payout altogether. A positive yield absolutely does not mean you're actually making a positive return on your investment.
Which brings us to Section 4, the income ETF trap and the covered call illusion.
Knowing that investors are just utterly obsessed with cash flow, the financial industry rolled out Step 3, income ETFs. These funds heavily utilize a strategy known as covered calls. Basically, they hold an index of stocks, but simultaneously sell call options on them. They are essentially acting as an insurance provider to other investors in the market. And in exchange for playing that role, the ETF gets an immediate, juicy premium, sometimes promising 8 to 10% annual yields dropped right into your account.
But there is a devastating true cost to that upfront premium. Yes, you get paid right now, but to get it, you're systematically capping your gains during market rallies. Think about it. The stock market historically makes the vast majority of its money during massive, unpredictable bull runs. With this strategy, you are literally selling away your right to participate in those runs. Yet, on the downside, that tiny premium does almost nothing to cushion a real market crash, meaning you still absorb nearly all the brutal losses. You're trading the incredible long-term compounding engine of the global stock market for a small, heavily taxed, regular payout.
Now for Section 5, investment certificates, the very top of the pyramid.
At this final step, we find highly complex derivatives that are often pushed really aggressively by banks and financial advisors. These certificates charge exorbitant hidden fees, sometimes hitting 1 to 2% every single year. But here is the truly wild part. If the underlying assets are stocks, the issuer actually keeps the dividends of those stocks entirely for themselves just to finance the complex structure of the product.
Ultimately, these certificates promise you a capped return combined with some conditional protection. Sounds okay, right? But if the market crashes below that specific protection threshold, boom, you suddenly absorb the full, devastating loss. Meanwhile, if the market skyrockets, the issuer pockets all the unlimited upside. You are taking on extreme downside risk in exchange for a severely capped return, effectively acting as the ultimate unpaid insurance provider for the bank.
Finally, Section 6, the DIY dividend, the ultimate solution.
Having dismantled all these traps, the truth is you absolutely do not need a magic machine or some complex derivative. You can easily create a do-it-yourself dividend. By just manually selling off a small percentage of your accumulation ETFs, you take total, uncompromised control. Need 4% this year? Just sell 4%. Don't need anything? Don't sell anything. By doing this, you drastically slash your tax bill because you only ever pay taxes on the profit portion. And most importantly, you fully participate in the unlimited long-term upside of the stock market without artificially capping your growth.
Now, I know the psychological fear of doing this is very real. You might be sitting there thinking, if I start selling my own shares, I'll panic and drain my entire capital. To protect yourself from that mental accounting bias, just follow these 4 simple mechanical rules. First, set an automatic scheduled withdrawal. Second, define a fixed frequency, like once a year. Third, stick to a predetermined percentage. And fourth, crucially, never renegotiate the rules on the fly. You are effectively building the exact same behavioral cage that traditional dividends provide, but without paying the massive tax and structural penalties.
I want to leave you with one final vital thought today. Before buying any financial product that promises you guaranteed yields, high payouts, or some magic stream of passive income, take a step back and ask yourself 2 fundamental questions. Where exactly is this money coming from? And how much does it truly cost me to receive it? Because if a product is just returning your own money back to you while charging you a hefty fee for the privilege, it's time to walk away. Thank you so much for joining me on this explainer, and I hope you're now fully equipped to protect your hard-earned capital.